The stock market crash alarm. 8 red flags you can't ignore. And what to do now. The whispers are growing louder. A stock market crash is looming. Experts are sounding the alarm, but the question on everyone's mind is when, not if, it will strike. With global tensions, economic uncertainties, and record-high valuations, the stage seems set for a dramatic downturn. But here's where it gets controversial. While some indicators scream caution, others suggest the economy is still on solid ground. So what's the truth? And more importantly, how can you protect yourself? 1. The yield curve. A recession's canary in the coal mine? Let's start with the yield curve, a chart that plots bond interest rates against their maturity dates. Normally, longer-term bonds pay higher rates because they're riskier. But when the curve inverts, meaning short-term bonds pay more than long-term ones, it's a red flag. Historically, every time this has happened over the past 50 years, a recession has followed. David Roberts of Ned Group Investments notes that 30-year U.S. bonds have recently paid 1% more than 5-year bonds, a trend that's been persistent for months. Yet, the U.S. economy remains robust, with low unemployment and the Federal Reserve cutting rates. So is this time different? Or are we ignoring the warning signs? 2. Employment rates. The silent screams of a struggling economy. When companies start laying off workers, it's a clear sign of trouble. Rising unemployment often signals a bursting bubble and an impending recession. In the UK, jobless claims rose by 25,800 in September, though the data is muddled by post-pandemic distortions. Corinne Lore of St. James's Place warns of a stagnant jobs market in the UK and US, urging caution. But here's the twist. Despite these numbers, the labor market isn't collapsing yet. Are we overreacting, or is this the calm before the storm? 3. PMIs, the pulse of economic health. Purchasing Managers' Indexes, PMIs, are like a monthly checkup for the economy. They measure new orders, inventories, production, and employment across industries. A score above 50 means growth, below 50 signals contraction. The UK's composite PMI dropped to 50.1 in September, while the manufacturing PMI hit a 5-month low of 46.2. In the US, the numbers are slightly better but still declining. Madhushree Agarwal of Ned Group Investments warns that falling orders and rising inventories could spell trouble. But is this a temporary blip or the start of a downward spiral? 4. Economic Surprise Index. Are we too optimistic? This index compares economic forecasts to actual results, giving us a reality check. A persistent negative surprise can signal shifting sentiment and slowing growth. Globally, the index is up, but the U.S. index has fallen sharply from its peak. Agarwal suggests this could indicate a cooling economy. But with inflation easing and interest rates stabilizing, is this just a natural correction, or are we headed for a deeper crisis? 5. Government deficits, the ticking time bomb. When governments spend more than they earn, deficits rise, and so does the risk of economic instability. The UK's deficit hit 5.3% of GDP last year, up 17.2% from the previous year. Roberts warns that deficits above 3 to 5% of GDP often lead to spending cuts and economic slowdowns. With the budget looming, commentators are speculating on how the government will rein in spending. But if deficits keep rising, could this trigger a full-blown crisis? 6. Government debt costs, the hidden danger. The cost of servicing government debt, measured by gilt yields, is another critical indicator. While UK gilt yields have dipped recently, a rapid rise could spell disaster. Laith Khalif of AJ Bell explains that the speed of the increase matters more than the yield itself. For instance, the 2022 mini-budget caused panic when yields spiked, but recent rises have been gradual, allowing investors to adjust. Are we underestimating the risk, or is this a false alarm? 7. Company results, the canary in the corporate coal mine. Earnings downgrades, missed forecasts, and dividend cuts are like red flags waving in the wind. Chris Beecham of IG Group warns that simultaneous downturns across sectors could signal a sell-off. During the COVID pandemic, dozens of FTSE 100 firms cut dividends, a stark reminder of how quickly things can unravel. While payouts are stable for now, a sudden shift could send shockwaves through the market. Are we too complacent, or is this business as usual? 8. Investor sentiment, the wild card. Investor behavior can turn a bubble into a bust. When sentiment is bullish, asset prices soar. When it's bearish, they crash. Mark Prescott of Morningstar Wealth warns that current valuations look frothy, while Tom Stevenson of Fidelity reminds us that bubbles can burst unexpectedly. Metrics like the P/E ratio and the volatility index, VIX, can help gauge sentiment. But with meme stocks and cryptocurrencies booming, are investors too detached from reality? Or is this just the new normal? The bottom line, prepare, don't panic. While the signs are worrying, no single indicator guarantees a crash. The economy is complex, and surprises are inevitable. But ignoring these red flags could be costly. Diversify your portfolio, keep an eye on key metrics, and stay informed. And here's the ultimate question. Are you ready for what's coming, or will you be caught off guard? Share your thoughts in the comments. Let's debate.